Here's the content for today's video. So we will first start with a recap on why classic filters such as the simple moving average, SMA, or exponential moving average fail in trading. Then we'll introduce the Butterworth filter. We will also present the non-causal Butterworth filter, which eliminates time lag. And then we'll also discuss our modified version of it, which makes it suitable for live trading. To start, and as a reminder, we are primarily interested in the growth of long-term investments and essentially which strategic investment insights can we generate that will help us drive this long-term growth. As a quick reminder, when we talk about long-term investments and the strategic investment zone, for us, this is dealing with investment strategies that have a time horizon going from a few weeks to a couple of decades. For your reference, this is a YouTube video where we discussed edge competition and costs for trading and investment strategies as a function of their time horizon. Now, since we are interested in long-term strategies, so long-term investments, we have also said in a previous video that raw price data contains high-frequency noise. And going back to our table, as you can see here for the strategic investment zone, so long-term strategies, they are primarily disturbed by high-frequency noise, whereas short-term strategies going from milliseconds to minutes, for instance, are primarily disturbed and influenced by low-frequency noise. And if you want to have a reference to that video, this is the one here that we show on our YouTube channel. So summarizing, we can't completely trust raw market data because of the presence of high-frequency noise, and this noise now masks important patterns, also introduces spurious fluctuations into market indicators, and finally, this noise blurs the structural market shifts, which can become difficult for us to detect reliably. Welcome to Alpha Quant Solutions, the platform where markets meet science and engineering to deliver your investment edge. Now, historically, the answer to this high-frequency noise has been to use these two classical filters. The first one is the simple moving average, the SMA, and the second one is the exponential moving average, or EMA. Now, these traditional filters, so the SMA and EMA, and all the variations thereof that are used in technical analysis, what we can say about is that they are useful, but they also do come with two main liabilities. And the first one is that they are unable in general to separate random fluctuations from structural market shifts. We show here an example of that. So we have taken the S&P 500 between 2019 and the mid of 2025. So we show the daily close price of the S&P 500 in light blue color, the corresponding 200-day SMA in white. And here we show around this yellow ellipse the COVID pandemic short-term market shock and subsequent recovery. And this is the first quarter of 2025 with the tariffs shock. And in both cases, you can see that the SMA was unable to pick up the market crash and also the following recovery. The next liability of these two filters is the well-known introduction of a time lag. Here is again an example, and we show the S&P 500 in light blue, the SMA 200 in white, and you can see for the market top, there is a delay between the top of the filtered version versus the top of the raw price data. Similarly, for the bottoming between the raw price data here and somewhere here for the filtered version. So in both cases, there is a time lag. In this case, on this specific example, it's approximately 3-4 months, but this time lag can vary, obviously. And it is this time lag holds for both methods. Also, in general, EMA is quicker to react, but it does still show a time lag compared to the original unfiltered price. So summarizing, what are the main drawbacks of the SMA and EMA, particularly during volatile or changing market conditions? Where we have stated them here. So we say that both the SMA and EMA struggle to distinguish between temporary deviations and true structural market shifts. That's the first one. The second one, we have observed a delayed recognition of new trends. This is essentially true for the SMA. And we have also seen that there is a generation of false signals that respond too aggressively to random price movements. And this is often the case for the EMA. And if you want a little bit of a review on the SMA and EMA and why they in general don't work for volatile market conditions, please have a reference to our YouTube video shown here. Quick disclaimers. We do not give investment or financial advice. We are only sharing our personal opinions. Finally, the objective for today's video is twofold. First, we want to amplify the signal-to-noise ratio of financial time series. And second, we want a method that also preserves the real-time usability. So we want to be able to use it for live trading purposes. Okay, now let's describe the conventional causal Butterworth filter. Let's present now the conventional and causal Butterworth filter. By causal, we mean that we are considering here a real-time implementation of this filter in the sense that it only uses past and present data for its filtered output. So here are a few elements we want to present and discuss. First is that the Butterworth filter is a well-established tool in digital signal processing, and it is renowned for its maximally flat frequency response in the passband. And the passband actually corresponds to the frequency range of the input signal that is allowed to be passed through the filter. Next, what we also say is that this filter, it avoids the ripples of or oscillations that occur in other filters like EMAs and SMAs, and hence it delivers a smooth attenuation of undesired frequencies. So when we compare the Butterworth filter to standard SMA and EMA, what we can say is that on one hand, the Butterworth filter offers a sharper frequency cutoffs and hence cleaner trend isolation. And on the other hand, it offers a greater tunability because the users are allowed to precisely set the cutoff frequency at which we want to remove the undesired fluctuations. So essentially, the Butterworth filter can be seen as an effective tool for smoothing noisy financial data while retaining the structural trend information. And on the other hand, also, when it is implemented causally, as we just mentioned before, so meaning it only uses past and current data, then obviously this filter becomes suitable for real-time applications. However, it has one main liability, which is when it is implemented causally, then, as we all know, it comes with the usual phase lag drawback. So what is this meaning? It means that the filtered signal, so the output of the filter, is trailing behind the real-time movements or is trailing behind the unfiltered raw signal. So these are the three main types of Butterworth filters. It can be used as a low-pass filter, a bandpass filter, or a high-pass filter. So by low-pass filter, what we mean is that it only passes the low frequency content of the input signal. So basically it removes the high frequency content. And high frequency is actually equivalent to short-term price fluctuations. So it means it removes any short-term and really the highly volatile price movements. Those are filtered out. And then it only retains the long-term market trends, so the slow-moving market trends. On the other hand, at the other end of the spectrum, it can be used as a high-pass filter, meaning it will only keep the high frequency content of the input signal, and hence it will remove the low frequency content. And what is equivalent to low frequency content is actually anything that has long-term price fluctuations. So anything that is slow moving is actually low frequency content. So it will remove the long-term price fluctuations, and hence it will only keep the short-term market trends or short-term volatility. It can also be used as a bandpass filter. So in this case, it will only keep specific frequency range between which the signal will be passed. And that can be translated into it will only keep medium-term market trends. So the Butterworth filter is superior in terms of frequency control and noise rejection when compared to the classical SMA and EMA. That is because we have precise control over which frequencies are passed through and which are attenuated. And in our case, we will use the classic low-pass filter configuration of the Butterworth filter. And why is that? Because we are interested in long-term market trends in the strategic investment zone. So actually what we want is to remove any short-term price fluctuations, which is equivalent to high-frequency noise. And this is best achieved by using a low-pass Butterworth filter configuration. So here is an example of a Butterworth filter from our quantitative investing dashboard. So we are in the filtering toolbox, and you see here in cyan color the Nasdaq 100 between January 2023 and 2025 July. And the green line is actually the output of the Butterworth filter. In this case, we use a cutoff period of 60 days. And when you select none here, this is the causal implementation. So you do see that there is a time lag between the output of the filter and the raw signal. You see it here. You see it also when the market bottoms here. But you will notice that if we were to reduce the cutoff period, then the time lag will also reduce. You see now it has moved in this case. But there is still a time lag, and that's a drawback of the causal implementation. Quick interruption. If you like the content, don't forget to subscribe and share the video with your network. Next, we move now to the non-causal version of the Butterworth filter. So in the previous slides, we have seen that causal filters, like the standard SMA, EMA, and also the so-called one-sided Butterworth filter, all of them inherently introduce a phase lag, so a time delay, meaning that the filtered signal trails the actual market movement. Now, to eliminate this lag, what we can do is apply a technique called forward-backward filtering, where basically the filter is applied once forward and once in reverse. Hence, this non-causal operation cancels out phase distortion, resulting in a so-called zero lag output that is symmetric around the original signal. So this removes basically the time delay. And this forward-backward approach preserves the trend structure without delay, making it ideal for detecting turning points with precision. Here are two schematic illustrations of a causal versus non-causal filter implementation. So for both, what we see is that the original signal is shown in light blue and the filtered in green. Now, in the causal implementation, suppose now we want to compute this precise data point, so we will call it at time t. In this case, we will use a range of previous data points up until time t, and it's schematically shown by this interval here. So we will use all these data points to compute this one. Now, in the non-causal implementation, then we also want to compute now this data point here at time t. So in this case, now we will use all data points prior to that within this range, the same range, and also some data points which are in the future compared to time t. So all of these light blue ones up until here. And that's the difference between the causal and non-causal. And you can see also that in the non-causal way, and then the time lag has disappeared. While you see it here that there is a time lag between the filtered and unfiltered version. Now, this backward-forward implementation of the Butterworth filter results in a cleaner and lag-free output that more accurately aligns with the original signal peaks and transitions. So this is really a great improvement. However, it comes with also two liabilities. On one hand, this version cannot be used in real-time systems because it requires access to future data. And second, also, it introduces the so-called boundary artifacts, particularly at the most recent data points, due to the absence of actual future values. So these boundary artifacts are also called endpoint distortions or edge distortions. And as we just mentioned in the previous slide, they happen near the start and the end of the time series, because near the start of this time series, we don't have data prior to that the filter needs to compute the filtered values here. And near the end of the time series, identically and equivalently, we do not have data in the future to filter out this data that is here. And I'm showing you here actually two runs of the filter because the filter needs to guess the values that it doesn't have. So in this run of the filter, it provided this filtered value signal in this green line that you see here. And then in another run, then the green line went up this way. So you can see that there is some instability in terms of the filter output when it has to guess what future values are because it needs future values to provide these filtered values here near the end of the time series. So basically, this is the what we call the endpoint or edge distortions at the end of the, in this case, of the time series. Now we will discuss our proposed modification for this non-causal Butterworth filter. So recall that the boundary problem or edge distortion that we are dealing with means that we can't fully trust the latest filtered values provided by the Butterworth filter, and this basically undermines the purpose of using advanced methods in live decision making. So what we propose to do is to extend the original unfiltered signal beyond the current time by appending a simulated random walk. So we will extend the data, and this will help the filter. Also, instead of it guessing what happens in the future, it will use this random walk data to filter also the most recent data points that we have. So essentially, we mitigate this boundary distortion effect by applying a so-called synthetic padding at the end of the price data, so at the end of the time series. So concretely, we use a technique called random walk padding, which basically extends the original signal by simulating future data points using a calibrated random walk based on past volatility. So this random walk is not arbitrary, it is actually calibrated on past volatility, and we'll show you how we have done that. Now, the output of this filter is now a zero phase lag, so it doesn't have any time delays. So that's the great thing about such an implementation. It has high accuracy with also an enhanced endpoint behavior, and it does not introduce any forward-looking bias. And in conclusion, this filter now becomes suitable for real-time applications. Now, why using a random walk volatility model to pad the original price data does solve the boundary problem? Well, this synthetic padding or the extension that we add has actually no directional bias and is calibrated to match the market's recent historical volatility. So this means that this statistical padding doesn't try to predict the future. There is no directional assumption here. Instead, it just creates a neutral continuation of market behavior that allows the filter to operate as if future data were available. Now, by using such a random walk volatility model, what we get as the output of the filter is a stable and lag-free signal that can be trusted right up to the most recent data points, so right up to the most recent time steps. And this is really very important. So now we have designed a unique filter that is on one hand lag-free, so there is no delay between the filter output and the raw price data. And on the other hand, it can also be used for real-time applications. So we can use it both for live trading as well as for long-term decision-making when we look at long-term investments. It can help us indeed to detect long-term trends since we are primarily interested by the strategic investment zone. So we are back into our quantitative investing dashboard. We're still on the same page, the Butterworth filter. Still with the Nasdaq 100, in this case between January 2021 and mid-2025. The unfiltered signal is shown in light blue, the filtered one in green. And in this case, no random walk volatility model is selected. So we see the traditional output from a causal filter, and you can see it is lagging the original unfiltered price. Also, as stated in the description, we can also now enable a zero-phase filter with boundary stabilization by selecting a loopback window from the random walk volatility model menu. So from here, this menu here. And this activates a non-causal, meaning it has a forward pass and backward pass Butterworth filter that also appends a synthetic random walk to the price series to stabilize the filter's edge behavior. So let's quickly demonstrate that and illustrate. We'll take a 5-year look-back window for the volatility model. And you see right away now that the impact of the non-causal filter removes the time lag between the filtered and unfiltered price, and it stabilizes the output of the filter near the end. But you will see some slight variations here at the end depending on the look-back window for the volatility calibration. So let's take, for instance, 20 years, and you saw a very small here shift at the end. But all in all, this is now a great tool, a great signal that we will further use later on in the filtering and classical indicators toolbox. Thank you for watching, and until next time.